Welcome to ACCA Performance Management Chapter 14, Divisional Performance Measurement and Transfer Pricing. In this lesson, we'll explore how large organizations measure divisional results and set internal prices for goods or services. By the end, you'll understand ROI, transfer pricing methods, and how to calculate the optimal transfer price that ensures fairness and goal congruence. Divisionalization means splitting a large business into semi-autonomous units. Each division acts like a mini-company responsible for its own costs, revenues, and sometimes investments. This improves accountability and motivation, but also requires fair and consistent performance measures. There are four main types of responsibility centers. A cost center focuses on cost control only, for example, an IT department. A revenue center aims to maximize sales but doesn't control costs. A profit center manages both costs and revenues, such as a restaurant branch. An investment center handles costs, revenues, and capital employed, like an entire business unit. Investment centers are measured using return on investment, ROI, and residual income, RI. For example, in Merit International, the housekeeping department is a cost center. Its focus is cost control and operational efficiency. The reservations department is a revenue center because it drives room sales and event bookings. Each individual Merit hotel operates as a profit center, managing both income and expenses to maximize property profit. Finally, Merit's corporate development team functions as an investment center, responsible for new hotel openings and capital returns across regions. ROI equals operating profit divided by capital employed times 100. It shows how efficiently a division uses assets to earn profit. ROI equals operating profit minus capital employed times cost of capital. It measures absolute profit after charging for the cost of finance. IOI is simple to compare but can discourage new investments. ROI is better for long-term decisions because it supports goal congruence. Managers accept any project earning more than the company's cost of capital. Let's look at an example. Division X currently earns 25% ROI but is offered a new project that gives 20% ROI. The company's target return is 18%. If managers are judged only by ROI, they'll reject the project even though it increases company profit. This is dysfunctional behavior. Using ROI solves this problem because it focuses on total pounds of profit, not just percentages, ensuring managers act in the company's best interest. Divisional performance can be compared using variance analysis, profitability ratios, and non-financial indicators such as customer satisfaction or staff turnover. Always remember controllability. Managers should only be judged on results they can actually influence. Now, let's move to transfer pricing, one of the most exam-tested areas in this chapter. A transfer price is the price charged when one division supplies goods or services to another within the same company. For example, a production division might sell components to a retail division. The purpose is to motivate both divisions while keeping overall company profit maximized. The objectives of a transfer pricing system are: goal congruence. Decisions should benefit both the division and the company. Fair performance measurement. Transfer prices shouldn't distort divisional results. Autonomy. Managers must feel responsible and empowered. Accurate cost tracking. Internal trades should be properly recorded. Wrongly set prices can lead to conflict or poor decisions even if total company profit stays the same. There are four main methods of setting transfer prices: cost-based, market-based, negotiated, and dual pricing. Each has pros and cons depending on capacity, competition, and managerial freedom. Cost-based pricing uses internal production cost as the base. If there's spare capacity, the price should equal variable cost. If the division is fully utilized, include fixed cost or markup. It's simple and ensures cost recovery but ignores opportunity cost, which may reduce goal congruence. Market-based pricing sets the price equal to the external market price. This works well when a competitive market exists because it reflects true opportunity cost. It promotes fairness and autonomy. Managers behave as if they were independent. However, if no external market exists or prices fluctuate heavily, this method may not work well. Negotiated pricing means the buying and selling divisions agree on a price that works for both. It offers flexibility and autonomy but can take time and cause disputes. Dual pricing credits the selling division at one price, say market value, while charging the buying division at another, often cost. It reduces conflict but increases administrative complexity. Now, let's discuss the optimal transfer price, the price that achieves goal congruence and fair performance measurement. The rule is simple. Transfer price equals variable cost plus opportunity cost. Variable cost represents the extra cost of production. Opportunity cost is the contribution lost if the product could have been sold externally. This formula ensures decisions that are good for the company are also good for each division. When setting prices, we calculate minimum and maximum transfer prices. The selling division's minimum is the lowest price it will accept. The buying division's maximum is the highest it's willing to pay before sourcing externally becomes cheaper. If spare capacity exists, the minimum equals variable cost. If there's no spare capacity, minimum equals variable cost plus opportunity cost. Transfers only occur when minimum less than or equal to maximum. Otherwise, one side loses out. Here's a simple example. Division A's variable cost per unit is £10 and the external selling price is £25. If spare capacity exists, the minimum transfer price equals £10. If there's full capacity, minimum equals £10 plus £25 minus £10 equals £25. If the buying division can buy outside for £25, any internal price between £10 and £25 works. That's the feasible range ensuring both divisions and the company gain. Comparing approaches. Cost-based works best when there's no external market and spare capacity. Market-based ensures goal congruence when competitive prices exist. Negotiated maintains autonomy and motivation. Dual pricing helps resolve internal disputes. Always explain in exams which method fits the situation and how it affects behavior. Transfer pricing is not only about numbers, it's about behavior. Poorly set prices can cause divisions to compete instead of cooperate. Managers might reject profitable projects or argue over fairness. A well-designed system promotes motivation, autonomy, and team alignment. Always mention these behavioral factors in your written exam answers. They are worth easy marks. Let's recap this chapter. Divisionalization promotes accountability and faster decision-making. ROI and ROI are the key performance measures for investment centers. Transfer pricing aligns divisional actions with overall company profit. The optimal transfer price equals variable cost plus opportunity cost. Transfers should only happen within the minimum-maximum range. And finally, always consider the behavioral side. Fairness, motivation, and cooperation matter as much as the calculation itself. Thank you for watching this ACCA Wiz session on divisional performance measurement and transfer pricing. If you found it helpful, please like, comment, and subscribe for more exam-focused videos. Keep practicing, stay consistent, and I'll see you in the next chapter.